Hi, and welcome back to the Food Fund. In this video we will be analyzing if Oatly stock is a buy. Oatly, stock ticker symbol OTLY, is just one of many companies we explore on this channel. The Food Fund is focused on all things related to investing in food, beverage, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. We have a lot of goodness to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Oatly. Oatly was founded in 1994 in Sweden by two brothers eager to leverage policy changes in agriculture transactions. They produces dairy alternatives using oats. Over the years, Oatly would add new investors including Blackstone, Oprah, Sean Carter, Howard Schultz, and a joint venture between North American and Chinese investors. Oatly went public in 2021 to much fanfare. Today Oatly employs more than 1,500 people and continues to have strong brand recognition in the oat milk industry. Now let's look at the price action. Starting with the 1-year chart, we see that Oatly had a CAGR of about -77%. Zooming out to the 2.5-year chart, we see that Oatly had a CAGR of -77%. Oatly's share price has fallen dramatically this year. If we perform a backtest comparison of investing $10,000 in Oatly versus the S&P 500, we find some unsurprising results. In that comparison with the S&P 500, $10,000 invested in Oatly would have been reduced to only $609 or a -78.3% CAGR versus $9,048 or a -5.3% CAGR if invested in the S&P 500. This demonstrates some interesting findings about Oatly's price performance. First, Oatly's share price fell alongside a dip in the market. This is somewhat reassuring, as it would have been much worse if Oatly had fallen while the market had risen. However, Oatly's fall was 15 times that of the market, which shows that there are unique pressures to Oatly outside of the broader market. An Oatly investment would have also been much more volatile, with a 73% standard deviation versus 19% for the S&P 500. Both the best year and worst year performances of Oatly were much worse than the S&P 500. Oatly max drawdown of 94% is about 4 times worse than that of the S&P 500. And surprisingly, Oatly underperforms the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Clearly, Oatly stock has been a bad investment for shareholders compared to other investment options. Let's take a look at the fundamentals to find out more. Gross margin is 17%. Not bad for a beverage producer. Revenue has compounded at around 43% over the past 5 years and has reached over $774 million most recently. Here is some good news. Despite the rapid share price fall, we can clearly see that the revenue growth has been steady over time, though the growth rate is slowing. Looking at cash flow, we see a -56% CAGR over the last 5 years for operating cash flow, while capex increased at a 12% CAGR. As a result, free cash flow had a -35% CAGR. This highlights Oatly's main problem. They are spending too much money to run the business. Cash from operations has been becoming more negative and only recently started to rebound. Similarly, Oatly had been spending more and more on capex with worsening operating cash flow. This was the biggest mistake. Only in 2022 did free cash flow begin to make its slow crawl upwards. At this rate, it will take Oatly 4 years to become free cash flow positive. Weighted average shares outstanding are expanded during the last 5 years, going from 407 million shares in 2019 to 593 million shares most recently. Oatly has diluted shareholders, largely due to the IPO in 2021. However, even after the IPO, Oatly has continued to dilute shareholders and may have to do so soon if the company cannot become free cash flow positive. Now let's view return on invested capital. Return on invested capital is more negative, having gone from -27.7% in 2021 to -28.7% in 2023. Unfortunately, the rise in revenue has not trickled down to return on invested capital. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. going from 47 days in 2020 to 65 days most recently. Oatly has gotten less efficient as time has gone on. Again, this is not good and shows Oatly's worsening efficiency. Now, let's look at Oatly's debt. The net debt to EBITDA has improved over the past 5 years and is currently -0.9. Since the company isn't profitable, this negative value means that Oatly has more debt than cash. This is not a good position for the company to be in. While revenue continues to grow, the rest of the fundamentals at Oatly are not good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Oatly. It is a beverage company with a gross margin of 17%. The 5-year revenue per share CAGR is 29% and the 5-year free cash flow per share CAGR is -22%. Again, good revenue growth but excessive spending leading to poor free cash flow. A return on invested capital of -29% is bad and does not look to be improving anytime soon. Next, the cash conversion cycle of 65 days is high and has not been improving. Concerning debt, a net debt to EBITDA of -0.9 means that Oatly has debt in excess cash and isn't profitable. So from a fundamental standpoint, Oatly looks bad. Now let's switch our attention over to valuation. Oatly isn't profitable, so we cannot calculate its value relative to the S&P 500. Likewise, the price to earnings growth, or PEG ratio, is not calculated for this company due to its unprofitability. Now let's hear what new CEO Jean-Christophe Flatin had to say in the recent earnings report. I am pleased with the progress that we made in the third quarter. Our profitability exceeded our internal expectations and improved sequentially in each segment. We are clearly starting to see the positive impacts of the bold actions that we have been taking over the past year, and we remain on track to achieve profitable growth in 2024. As we move forward, we are doubling down on our asset-light production strategy. After a detailed review of our supply chain networks in EMEA and Americas, we have found ways to service the growing demand by expanding capacity at our existing facilities in a more gradual manner. As such, we have decided to discontinue construction on the third production facility in each of the 2 segments. We believe that this change in our approach will increase our focus by reducing the complexity of the supply chain, which increases our confidence in our longer-term margin targets. We also now expect to have lower capital expenditure requirements, and we expect to spend below $75 million in capital expenditures in each of 2023 and 2024. We are also adjusting our 2023 outlook to reflect an acceleration of our strategic actions, including shifting the customer mix in America's food service and incremental costs related to Asia's strategy reset. We now expect full year 2023 constant currency revenue growth to be near the low end of our 7-12% range and fourth quarter gross margin to be in the mid 20%. It seems that Flatin has gotten the message to drastically cut spending and maybe the company will have a chance. The suave positive for Oatly is that customers love the product and that continues to drive sales. This is actually the hardest part of building this business and Oatly has already accomplished it. Despite reports on new industry entrants and growing competition, Oatly has managed to keep growing. However, they must cut spending. I think they need to cut even more aggressively to give the company a chance. Oatly only has $283 million in cash, which means they only have 12 months of operating runway before they run out of money. If we look at the major expenses, we see that the cost of goods sold is growing about 50% per year. Oatly must find a way to get cheaper oats. The company will not be sustainable as the cost of their primary ingredient doubles every 2 years. Similarly, selling general administrative expenses and research and development expenses are also doubling every 2 years. I think Oatly should heavily leverage generative AI to cut ad spending. In fact, I would accept a 2% to 5% revenue growth rate in exchange for more aggressive cost cuts to get selling general administrative expenses under $200 million. There is a lot of work to be done if Oatly is to survive, but I do think it is possible. For now, it is way too risky for me. I will pass on adding it to the watch list. Many thanks for watching. What do you think about Oatly and its strong revenue growth? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.